This is a paper I wrote. So I work at the Dutch Central Bank, just like Henk-Jan, who presented first. We wrote this paper. So I should say I work in the Financial Stability Division. So my day job is to safeguard financial stability of the Dutch financial system. And at some point we started wondering, could climate-related risk be a systemic risk to the Dutch financial sector? So we started working on this stress test, but of course this does not represent necessarily the views of DNB, just of the authors, which explains why Henk-Jan came up with a completely different stress test model, also in the same organization. So I'm going to start just to give you a bit of the gist of what we're doing. So we did a stress test. We defined 4 scenarios, and I said we focused on climate-related risk, but we actually focused on transition risk specifically. We felt the need to narrow it down to make it a bit more tangible, and we're hoping to still do work on physical risks in the future. But for now we looked at transition risks, and something that was very important for us, and I think that distinguishes maybe our work from some of the other stress testing work that we've seen, is that we really wanted to align it with what's already the kind of the standard practice within central banks and supervisors for stress testing. So some of you might be familiar, for example, with the stress test conducted by the EBA, the European Banking Authority, every 2 years for the European financial sector, widely publicized. Bank of England does their own stress test for the UK financial system, Federal Reserve in the US, etc. And we wanted to kind of align with the methodologies typically used by these supervisors, so that we could give them something that could readily be applied kind of in the existing models. So when I go through the methodology, I think that's the thing to keep in mind, is that we wanted something more of an add-on to the models that already exist, as opposed to coming up with something entirely new. And what's nice is we were able to apply the stress test to pretty granular data for the whole Dutch financial system, meaning banks, insurers, and pension funds. So, and maybe just to give you a hint at the results. So we calculated losses on the asset side of these banks, insurers, and pension funds. It's about 1 to 3% for banks, 2 to 11 for insurers, and 3 to 10 for pension funds. Now, from this picture, you might get the idea that banks are the least affected by these transition risk scenarios. But that's not necessarily true, because banks are way more leveraged than insurers and pension funds. So 3% of assets for a bank could bring it quite close to default, whereas 11% of assets for a typical insurer actually still leaves it in a pretty financially sound state. Okay, so what did we do? First, let me just go very quickly through a bit of the related literature. So there's obviously literature on, how does the transition interact with the real economy, starting with Nordhaus, more recent work, including by Irene. And then there's the literature on climate stress testing, also by Irene, incidentally. And so I actually already mentioned this, but we try to really bridge the gap between what academics are already doing and what supervisory standard practice is doing for stress testing. Okay, so how did we do it? Take a number of steps, and this top part of the figure here is basically what, for example, the European Banking Authority does when they conduct their stress test for the European banks. So they start with a scenario that they then, it's a macroeconomic scenario. So for example, they suppose that there's a shock on house prices of 20%. And then they apply that to the exposures of the banks, put it in their stress testing models, can be bottom up or top down. You typically have both, so maybe a quick note on that. In a typical stress test, banks would be asked to calculate their own losses under stress, and then the supervisor will also calculate it using a top-down model to kind of compare the results and as a quality assurance. So we have those top-down models at DNB, and so we just wanted to input our results that were adjusted for climate risk into those existing models. So how do you adjust this methodology for climate-related risk? Well, we came up with the following. First, the scenario itself. Instead of taking a macroeconomic scenario where you suppose, a drop in house prices or something like that, we start from an energy transition scenario. We'll say a bit more of that in a moment, but for example, we look at the increase in a carbon price by $100 per ton of CO2 emissions. And then we try to see what happens to the macroeconomy based on that. So you get a macroeconomic scenario, but calibrated on the basis of a transition storyline. So that's one big difference. And then the second big difference with a typical exercise is that we don't just stop at the macroeconomic scenario, but then we made a split to what happens in various economic sectors. And we do this because, quite intuitively, there was a panel on stranded assets this morning where they went into it in detail, but some sectors are obviously more at risk from the energy transition than others. And that also means that as a financial institution, you can, to some extent, diversify your exposures away from these risks. So, of course, if you want to mainly finance gas and oil extraction, you might be way more at risk than if you're more into financing big tech companies or something like that. So we needed to make that sectoral split to kind of get that diversification. So going from there, starting with the scenarios. Because of the time, I'm not going to go into it in detail. Very short, we look at two dimensions: a policy shock, which we define as this increase in the carbon price, and a technology shock, where we assume that the amount of renewable energy in the economic system, the share of renewable energy in the energy mix, increases, actually doubles in a period of 5 years. And so we then apply these to a macroeconomic model, see what comes out. We have on the top right a double shock where we combine the two effects, and at the left bottom a confidence shock where we basically say, you know what, maybe there won't be policy, maybe there won't be a technological breakthrough, but investors will still get a little bit nervous because of these types of conferences where we tell them that actually a lot is happening in terms of climate change. And so as a result, they lose some confidence, and there's still a shock there. So I'm going to skip over the details. Okay, how did we model these scenarios? We used a macroeconomic model called NIGEM. You might be familiar with it. It is one of the advantages is that it is kind of a model that is out there and that a lot of banks or financial institutions are already using for macroeconomic projections and stress testing. A big disadvantage is it's not an integrated assessment model. There is no climate dimension in the model. So we had to make assumptions to kind of, instead of explicitly modeling, say, emissions or temperature changes, we said, well, just taking that there is going to be an energy transition, what kind of shocks can we expect in the real economy? And then made some assumptions in the model to get those shocks. So there's no explicit link, and this is clearly something for future work. Taking an IAM that has that explicit link would be useful. Why didn't we do it? I mean, there are IAMs, obviously, but a typical IAM, so integrated assessment model, doesn't deliver all the outputs that we would need for a standard stress testing exercise. And again, if we want to align with the stress testing models that we already have as central banks, as supervisors, then we need a model that has a vast array of outputs, such as what happens to equity indices, what happens to unemployment in the economy, what happens to interest rates in the economy. And most integrated assessment models don't deliver these, which is why we stuck with NIGEM. So again, some details on how we calibrated the model. Skip them for now, but in the Q&A I'm happy to talk about it. And just a quick illustration of what comes out of it for the 4 scenarios. So this is what happens to GDP in each of the 4 scenarios. And to kind of explain how to interpret this graph, if we take the double shock, which is the gray line, it goes the deepest down in the 3rd year. It has the deepest bottom. and you see it's around -4 on the left axis. What does it mean? It means that GDP in the double shock scenario in the third year is 4% lower than in the baseline scenario. So NIGEM, as an economic model, predicts a baseline path for GDP. And in the double shock scenario, GDP is 4% lower in the third year. So that doesn't mean that there's negative GDP growth per se. It just means that it's a bit of an opportunity cost relative to a world without any climate shocks. We're worse off in the double shock scenario. Okay, so then I think one of the most interesting parts of this approach is how do you then go to a split across different sectors in the economy? How do you go from these macroeconomic effects to what happens at the sector level? And here we came up with a bit of a trick. We saw in the previous paper this morning, by Henk-Jan, they looked at scope 1 emissions. We looked at embodied CO2 emissions using an input-output model, which means we take all of the emissions in the supply chain for a firm's final products. So if you produce a car, then we're not just going to look at your emissions as a car manufacturer, but also at the emissions of the rubber manufacturer that produces tires for your car. Also at the emissions of the transport companies that bring all your resources that you need to produce the car to you. So full supply chain emissions. And I mean, I think this has pros and cons. One of the advantages is that even basically the end user of emissions pays for those emissions. So that's the way we decided to go about it. And then, on the slide I say we use a CAPM inspired approach. What does that mean? So in the CAPM model, which a lot of you might be familiar with, there's a loading factor. So suppose equity markets go down by 10%, then the CAPM model will predict that some of your stocks, if your loading factor is 1.5, then that means that this particular stock goes down 15%. We did something similar for climate risk, transition risk. So in our macroeconomic scenario, stock markets go down, and using these embodied CO2 emissions, we determined, do you go as a firm down more than the market or less? Now, I know I have to finish up at this point, but so that's most of the methodology. Maybe a quick note on data. So we had equities and bond holdings by Dutch financial institutions, and in addition, corporate loan portfolios of these institutions, or for banks actually, which we requested through a survey. It's obviously confidential data, but as a central bank, we had the advantage we could do that. And then one of the problems you run into, because we use NACE codes, as a lot of this research does, and one of the problems is that a lot of companies are marked as a finance. So if you take Shell, which is an oil company or an energy company, they have a unit called Shell Finance, which issues all the bonds. And so this is seen as a finance company, but actually we wanted it to market as an oil company. So we did this correction on the NACE codes. So then it goes into our stress testing models. Again, if you'd like the details, happy to talk about it later. These are the results, but I kind of told you about it on the first slide. So I'm just thinking, is there anything else I would like to leave you with today? Well, maybe just the final slide, that there are a lot of interesting avenues for future research, but what we liked about this exercise is that it allowed us to take the models we have and add climate risk into them. Thank you.